So I hope everyone can hear me okay. Give me 1 second. Good morning everybody. Firstly from myself, thank you for joining us this morning. And from the business, thank you for your continued support in what can, I guess, only be described as a rather difficult period. Not just in the market, but in our daily lives as well. Today, in essence, is the final day before a full lockdown here in SA, so I imagine a lot of you are dialing in from home. This is also the fourth manager Q&A we've hosted so far over the course of the past week. We've had updates from ABAX on our flexible income fund. We had FPA yesterday chatting about Global Flexible, apologies on Tuesday. And yesterday my colleague Neil had a fantastic chat with Andrew Headley at Veritas regarding our Global Equity Fund. Should you wish, I believe these recordings are available. If you could just get in touch with your Nedgroup Investments Relationship Manager and they'll be able to assist you. Today I'm very happy to have Iain Power on the line. Iain is the CIO at Truffle Asset Management, who sub-advise on the Nedgroup Investments Balance Fund as well as the Managed Fund. The Balance Fund has held up relatively well over the past couple of months, and in fact over all periods going back 7 years since inception is ranked in the top 20% of the SA multi-asset high equity category. On that note, Truffle have for some time been regarded as a very strong equity house, and I think it's worthy to mention that last month they won the Raging Bull Award for their fixed income product as well, so which I think shows the skill set across multiple asset classes at Truffle, and something that the Balance Fund is able to leverage off for sure. And in light of that, we also had a podcast with Iain from last week with my colleague Rob Johnson, which I believe is available on all the regular podcast channels. Iain, welcome to the call and thanks for taking the time out of your day to chat to us this morning.
Thanks, David.
I do have some slides. I believe you aren't able to see them, but I don't think that'll be a major issue. The previous calls we hosted have all been verbal. But the first slide, which I have put up for those that are able to see it, was one you used at your fund manager workshop, which spoke to the COVID-19 virus and its escalation outside of the world of China. This chart would look very different today. This was from the end of Feb. I checked this morning, and at this moment in time, I think there are about 470,000 cases globally. And I guess it's tough not to talk about this obvious elephant in the room. So let's begin with the virus. We are now starting to see the economic response, particularly from reserve banks around the world. The SARB was a little bit late to the party, although we did have a 100 basis point cut last week to about 5.25%. So where do you see rates going from here, and is it a matter of how low can it go?
David, I think, as you said, maybe to take a step back, is that the level of infections outside of China obviously continues to accelerate. So we are seeing exponential rise in terms of the rates of infections, and I think the concern is that this simultaneous effectively global shutdown, excluding China, which is now starting to ramp up, but effectively is taking every geography other than perhaps China offline at the same time in terms of demand. So I think the tools which governments and sovereigns have at their disposal for this type of, event are actually fairly limited. So the one which you've already spoken to is monetary policy, and I think it's fair to say that the direction of rates is down everywhere. But the reality is it's not really a cost of funding issue to the extent that it's expensive to borrow. The fact of the matter is when people around the world are having to go lock themselves in their homes for 3 weeks or in some cases in China 3 months, you are effectively removing a big pillar of demand and commercial activity out of the economy. So in other words, does lower interest rates help that? And the answer is not really, because you can't go out and really consume to the extent that sort of normal activity would. So I think the direction of travel for rates is obviously clearly down. But obviously the central banks have and governments have other tools at their disposal, and the one is fiscal stimulus.
Yes.
And everyone would have read, that there's helicopter money. Hong Kong, I mean, they gave all their citizens $1,200, and I mean, there's sort of talk in the US that we're going to have a similar, fiscal stimulus. But the reality is that the level of spending in the economy has been interrupted. So you've had the simultaneous demand and supply shock, which is going to be very difficult to support with existing government policy. So I think we all need to sort of expect that we are going to have a sharp downturn in terms of economic activity. And I think, as you said in terms of your opening statement, that the infection rate continues to climb. I think the impact of the infection and the impact of the quarantine and lockdown is really going to be determined by the extent, in other words, how long this takes to actually remove the virus. And then obviously the longer it takes, the bigger the damage that it does to growth and by definition corporate profits. So I think that's the big uncertainty. So to the extent that central banks have some of these tools, monetary and fiscal, we think they will pull those levers, but it is going to be very difficult to fill those holes. To the extent that commercial activity, pretty much ceases over this period.
So I guess any decision that the SARB does make in the coming months will be based more on economic growth. I guess as opposed to something like inflation. We imagine inflation to stay within that band of 3 to 6%. I think it's roughly in that 4.5 mark at the moment. Despite the rand weakness, we've seen the oil price drop significantly. So there's not a hell of a lot of upward pressure in terms of inflation. So maybe I agree with you here in the sense that everything the SARB does will be built around growth and a recovery, should that take place over what period of time?
I think that's right. I don't think there's a massive inflation push at the moment. But the one constraint that I think South Africa does have as a relatively open economy is that we depend on offshore capital flows to fund our deficit. So I think the extent to which we can cut rates is probably a little bit more limited compared to perhaps other geographies. And certainly I think from a fiscal perspective, the country's fiscal position is not particularly strong, and I think the COVID-19 really is just going to exacerbate what is a very difficult growth economic environment for South Africa, and obviously open up all those risks to the downside across all those various metrics. So I think there probably is some scope to have further relief on rates. But I would be very surprised if if there was a significant, in other words, to the extent that we've seen in some of the other economies, reduction in terms of those rates.
Yeah, and I guess the developed world doesn't really have that room to move in terms of rates. They're pretty much close to zero now. So we do have a luxury in the sense that we were coming off about 6.25% before the virus really hit.
100%. And I think maybe just to add on to your point, which I think is a good one, is that we have made the point before that the Western world by and large has exhausted monetary policy as a mechanism to resuscitate and support growth. And to the extent now that I think just fiscal stimulus is left, I think we all need to sort of prepare ourselves for governments around the world to really start to access fiscal stimulus in a way which we haven't seen before. And I think as the economic consequences of what we're seeing now start to roll out, we just think that pressure on sovereigns will continue to build to intervene in the sense of states' participation in their economies. And I think you're going to see a lot more of that activity coming. And then, of course, the question down the line is, who pays for all of this in the end?
Yeah.
But I definitely think that's what we're going to be seeing.
So Iain, I've stuck up my next slide here is actually piggybacking again off what you presented at the Fund Manager Workshop a couple of weeks ago, was the SA debt to GDP ratio, which was kind of hovering now at the 60% mark. I guess one would expect materially lower GDP in the coming quarters, but also a lower tax sort of revenue feeding into government coffers. So does this have a significant, I guess, risk to what is already a precarious national fiscus, and how would that maybe change or shift your forecast from a debt to GDP ratio perspective?
Yeah. So I think it's a good point, and I think if one looks at the balance sheet of the country and we look at the debt position, obviously South Africa is in a difficult position to the extent that the budget actions were not sufficient enough to stabilize our long-term debt path. So if we consolidate the parastatals and Eskom along with our public sector debt, the government debt, we comfortably will be over the 70% mark. That's 72 odd percent in the next 2-3 years. That was where we were as per the budget. Now with COVID-19, unfortunately, as you pointed out, the tax base is going to come under significant pressure. We are probably going to see unemployment rise, which means there's less people paying tax. Corporates will make less money. And then on top of that, we are going to have more fiscal participation or support from the government. So in other words, the government, like other governments around the world, is going to be forced to support businesses and consumption and the economy, and that will come at a cost to the fiscus. So we think our fiscal deficit, the expectation of a 7% deficit for the year, that number could be closer to 9%. And certainly from a debt to GDP perspective, given those changes in those factors that you've mentioned, lower taxes and perhaps higher expenditure, we are likely to see debt to GDP accelerate. So, from a truffle perspective, that just further entrenches our view that, from a solvency and in terms of rating perspective, South Africa is going down a path where at some point we are going to either have to have IMF intervention, or we are going to have to pull back on those government expenditures sharply to be able to balance our books. But the COVID-19 has just tipped a situation which was difficult and made it a lot more challenging.
Yeah. Okay, thanks for that, Iain. So yesterday we heard from Andy Headley at Veritas around what he believes or which global sectors would be hurt the most by the virus, and those that could stand to actually outperform. Obviously, they run a global mandate, but I'm keen to hear your thoughts on how this might translate to the SA market from maybe a sector and company point of view. And just as a reference for you, Iain, I've stuck up a slide here. This is also one from your Fund Manager Workshop presentation that talks to the PE levels of the JSE, excluding NASPERS, which a couple of weeks ago, or maybe 3 weeks ago, was sitting, I think, just north of 9, the ratio. Maybe touch on where that might be today and allude to which sectors you think could stand to perform relatively well.
Okay, so I think that's an interesting insight, because what we have learned from digging through the historical data that we could find in the 1918 Spanish flu pandemic is that effectively the lockdown and the effects on the economy and certain sectors are not all the same. So as you've said, there are certain businesses which should be relatively more immune and defensive, and then more other sectors and businesses which are going to be, I guess, more severely impacted. So, when we look at what we found going back in the data in 1918, is that we found that the services sector was particularly hard hit. So anything revolving around services and where it had a bearing on entertainment, leisure activities, from restaurants, food service operators, all of these type of businesses really came under severe pressure. And obviously all those subsectors and businesses feeding into those particular industries then got impacted. So we found some data of revenues for some of these businesses falling as much as 80%. And lots of these service businesses run on very thin margins. So to the extent that you have no revenue or sales of your service over that period, you then are having to carry these costs through that same period. So, when we then extrapolate that and take that through into, I guess, our own market and globally. So to give you an example of some of the businesses that would be, obviously very impacted, would be like the travel services. You've seen Avis, Budget globally, those share prices are down 80%, airlines. And then, of course, bringing it closer to home, a business like Bidcorp, which effectively supplies restaurants and I guess similar catering operations with their food requirements. All of that literally gets turned off overnight. And on top of that, some of their exposures would be to the small and medium vendors or restaurant owners, which don't have the balance sheets and the cash flow to be able to withstand a lot of these impacts. So I think at a portfolio level, typically what we would be doing is we'd be standing back and saying, well, which businesses do we think will be more exposed? And, one of the messages that you would have heard from Truffle over the last couple of years is we've been trying to focus on businesses which, effectively do not have a lot of leverage or a lot of debt. Because irrespective of the underlying business model, if the business is economically sensitive, in other words, the profits are a function of the level of economic activity and are less defensive or annuity-based, when you have an interruption to those cash flows and you are carrying a high level of debt, that is when you can potentially suffer an equity shock. And I think the biggest example we could probably talk about is like a Sasol here, where overnight their revenues fall by 40% and you're sitting with 137 billion rands worth of debt. So there's going to be lots of examples globally of businesses like that. So I think at a portfolio level, the first thing that we've been doing for quite some time is to make sure that the businesses that we've exposed capital to are not overly leveraged. In other words, they have certainly enough headroom to be able to repay that debt. And then on top of that is your question from an industry-specific point of view, is to make sure that we are trying to avoid businesses where the profitability of those businesses is very volatile and subject to, obviously these factors that I've spoken about. So, for example, we have no Bidcorp in our portfolio. Secondly, the other thing that we would have done is not all of the companies are equal in terms of their underlying exposures, and I'm talking specifically here about the banking sector. So Standard Bank, for example, has a particularly big exposure to West Africa and to some of the oil-producing countries. And with the collapse that we've seen in the oil price and the knock-on effects to some of those geographies, Nigeria, for example, where we're likely to see massive currency pressure, further, Angola, you're likely to see further bad debt. So, to the extent where we can switch and improve the robustness of the portfolio, we obviously take those steps. But, from a company point of view, a lot of the businesses that we've invested in, are really defensive insofar as their nature. You will know we have big exposures to Naspas, which, from a geographic point of view, China seems to be coming out of their infection period and seems to have stabilized it. So, also the business model being gaming and social media should benefit at a time when we all have to stay at home and in lockdown with our spouses for 3 weeks. So I guess, the time that we're going to be spending on social media and gaming and these type of platforms will probably be very robust and be supported. British American Tobacco, which is another big holding we had a conference call with them at their Capital Markets Day 7 days ago, and they said they've seen absolutely no impact from COVID on their business yet. And, to the extent that we've seen some of the tobacconist shops in Europe have been left open as part of an essential service, I guess, also gives you a sense of the defensiveness of those businesses. So I think at a portfolio level, one's looking to improve the quality of the businesses, reduce leverage across the fund. In other words, don't have exposures to businesses which may not be able to weather the storm. To the extent that you have an interruption to profits and then you can't repay debt. So I think it's sticking to the knitting, which I think is what we've been saying in terms of the hygiene factors. and making sure that we try and preserve as much capital as we can at a time like this, and position the fund in good quality businesses, so when the ultimately we get on top of the COVID-19 and the recovery comes, you should be able to have quite a nice sharp recovery, having been invested in better quality businesses, which should weather the storm and then be able to benefit from an improved economic situation.
Thanks, Ian. Quite a lot to take in there. So I'm going to go back slightly through some of those names. I'm not sure about Naspers, but Process is up year to date, which is one of the anomalies, I guess, on the JSE. You also touched briefly on the services industry and Bidcorp obviously feeling a lot of pain, and maybe this might ring close to home for a lot of the listeners on the call, but it's sitting in the queue at Spar last night and everyone with their trolleys full. Maybe this is a bit short-termism in terms of my thinking, but do retailers stand to gain in this over the short term? I mean, Woolworths, from what I recall, 3 years ago was trading over $100 and is now, I think, sub 30. Shoprite has previously almost reached 300 and I think is now a little at about 100 Rand or so. Is that a fair assumption to make?
So I think retailers, food retailers, as are drug retailers, should be more defensive versus discretionary spend. So any discretionary spend, businesses which rely on discretionary spend are going to face pretty severe declines in terms of their revenue. And obviously we all have to eat and we all have to, get our medication. So, historically are more defensive insofar as their revenues, but will still be impacted by what is happening. So a lot of these food shops also sell a lot of discretionary items as well. So to the extent that those items will sell less, but you're 100% correct in that these businesses should be more defensive than a clothing retailer, and especially if this lockdown has to last, in Europe and in South Africa. I mean, if it has to go on for a lot longer than 3 weeks to get it under control, those impacts will be a lot more severe. But, I think the point that you made earlier in terms of the share prices is a lot of these share prices have come under a lot of pressure. And Woolies, for example, is a business that and these levels and should be relatively defensive compared to some of the other businesses. So I think if you are a fashion retailer, I'm not sure how many people are going to be spending in Europe buying fashion goods, or certainly from an SA perspective. And I think that goes for car dealerships as well. So I think all those type of discretionary expenditures we can expect for the next, foreseeable future until we get it under control, that those expenditures are going to go pretty much to zero. And then the question is, can those businesses survive from a balance sheet point of view?
Thanks for that, Ian. And then I've just moved on to another slide here, which will probably be the final one for the call. Just looking at asset allocation over the last sort of 14 months or so. And we've seen a pinch, I guess, in SA equities and foreign equities since the start of the year. So the fund really took on a more cautious tone. It's that foreign equity component that I want to touch on briefly. So I know you held some, or maybe still do hold, your S&P put options, which I imagine are quite nicely in the money, as well as a sizable cash position. Does this afford you a bit of dry powder to use when opportunities present themselves? And if so, what global companies are you looking at the moment?
Went into the year being quite cautious and defensive, and managed to buy very cheap insurance on the S&P at pretty much close to its all-time peak, which was about 3,350. So we bought put options at that level. Those put options are all deep in the money now, and obviously would have protected a significant amount of capital as markets drew down. But on top of that, we also had built up a lot of cash offshore. So, and that was just really because we felt valuations, particularly in the US, had become quite stretched, at close to 20 times multiples, and that earnings risks were all to the downside that we felt. So we think this year now you'll probably see S&P earnings contract, and it could go down by as much as 20%. that's why, equity markets have come down. So, being in a position to have insurance, and our insurance is now paid off, that gives us flexibility because we've now obviously protected capital on the way down, so we haven't suffered that decline. And then obviously our cash balances we are now able to deploy into assets which are now 30-40% cheaper than they were at the beginning of the year. So your question in terms of which shares have we been nibbling on, one of them has been NetEase, which is a Chinese gaming company, which share price came down 25-30 odd %, so we've picked up some of that. Google, which share price came down also around about 35 odd %, closer to $10 a share, $10.40. Picked up some of that. We bought some more Philip Morris. We bought some Unilevers, which have also been smashed. So effectively, what we've been trying to do is buy into good businesses with very strong moats or competitive advantages. Some of those businesses have net cash on the balance sheet, like a Facebook as well, another name that we picked up at about $140. So some of these big businesses have 10-15%, almost 20% in NetEase's case of their market cap in cash at the low point. And I think that also provides you with some comfort in this environment where businesses are under pressure in terms of financing and funding, and that they will remain in business. So I think these type of businesses should be defensive, the ones that I've mentioned. And the fact is that we can now buy into these cash flows of these businesses at significant discounts, and some of these companies are paying us dividends in excess of 10%, the dividend yields, which we think is fairly compelling. So, to the extent that one has had a defensive positioning, I think what we've been able to do is preserve more capital, and the embedded value in the fund is growing to the extent that we've now managed to buy a lot of quality or better businesses at cheap prices. And when things normalize, one should see quite a sharp repricing of these high-quality assets back to their historical multiples.
Okay, thanks for that, Iain. And then probably the final point there is just looking at the foreign bond component. I think it's roughly, when I made this chart, it was 9%. It's probably almost 10% of the fund today. These have predominantly been SA corporates listing dollar-based bonds. Have these kind of really buffered the portfolio quite nicely? I guess it's 17.5 Rand to the dollar.
Absolutely. So the fixed income has done well in an environment where equities have experienced a 30% drawdown. We did sell and take some money off the table in some of our offshore bonds, and effectively now getting some of that cash ready to redeploy into some of the equities. So yes, we still have a position, but it's not as big as it was. And now effectively wanting to have some more cash to take advantage of what we think will probably still be quite a lot of volatility in the market going forward. And I mean, maybe just one last comment as well is, one of the factors that we are watching is when those infection rates start to stabilize around the world. Because when we went back and looked at the data in 1918, what we found is that as soon as the Spanish flu infection rates started to stabilize in, I think it was February 1918, the Dow then proceeded to go up 50% over the next couple of months. So I think, all that the market will be wanting to see now is, at what point can this be contained, and when the actions taken are starting to take effect, which means that the recovery starts to become visible insofar as, when those infections then start to decline and economic activity resumes, corporate profitability accelerates. So, the big question that I think we're looking at now is, how long is this going to take to bring under control? And, if everyone takes their medicine, and it sounds like the US, Donald Trump was sort of pushing to have the economy open by Easter, which would not be a good thing if this was not under control. But if everyone does what they need to do, as soon as those infection rates start to plateau, I think you're going to see risk assets start to aggressively reprice what will be a economic recovery, which will come in 12 to 18 months' time.
12 to 18 months. Okay, thanks for that, Ian. I think one of the pleasures I have chatting with your team is how academically they approach, some of these major topics and themes, and just what you touched on in terms of past pandemics. The guys at Truffle don't just go 10 feet wide, but it's 10 feet deep as well. So I think the listeners appreciate that as well. So thanks for your time this morning. Unfortunately, we do have to finish the call. And thanks also to those who have joined us from your homes across the country. I'm sure you found Ian's insights incredibly helpful, and hopefully can provide some degree of comfort to yourselves and your clients. This call has been recorded along with the previous ones we've had this week. And please do get in touch with your Nedgroup Investments Relationship Manager should you wish to receive these. And please join us, I believe, at the same time tomorrow, where Omri Thomas will be talking about the Opportunity Fund. And then moving into next week, we are hosting calls with the PMs on our Global Property Fund, the Global Emerging Market Fund, our Global Cautious Fund, and then before joining, hearing from Yanni Leach, who's head of our Nedgroup Investments Core Range on Thursday. And finally, to close out the week, we have Anthony Sedgwick from ABAX chatting on SA Equities and the Rainmaker Fund. So thanks again, Ian. Thanks for everyone dialing in. Take care and keep safe. Thank you.
Thanks, David. Thanks to everyone. I hope you have a good day.
Cool.
Bye-bye.
Cheers, Ian. Bye.